5/11, 2014, 9:07 a.m. To all of the traders, take care of your mothers. It's Mother's Day. So we're going to be taking a look at this weekly format on the S&P 500. We started out the year in January with the distribution. We came back in February and we got a nice movement off of the lows here with 1737 for Q1 of 2014. From that point, we came roaring right back to make these weekly highs that are narrow range. 1883 on March, that was the high. The movement here for April was 1873. We put in that high right below 1900 at 1897.28. The low now within this wick was 1814 on this S&P 500. Now, we've been trading calls and puts on it. And the thing about it is that the mathematical ratios between the call buyer and the put buyer are totally out of whack. So on a weekly level, you can see the up weeks right here, but you can also see where those dips came in. The other thing that we're going to say is that we're going to have one or two scenarios are going to happen. With this reversal that's right around the corner, if we're going to break that 1814 right here, that was that low right there for that week starting out February. This low right here is where they came in on the beginning of April, and we went straight up, but we closed narrow range on a weekly level. Now, having said the first week of May, we had no commitment as far as I'm concerned. That means that the buyer of S&P 500 stocks in the index are not fully committed. This is what it looks like there. On the other area that we've been looking at is the S&P 500 index here. It's a daily movement, and when we take a look at the daily, we can clearly see where that nice move down in January, we rally on up. This is what it looks like in the daily format. I'm going to blow this part of the chart up. I got to make sure that it's in there. And what we're going to do now is we're going to right click and we're going to go right up here to this info tool. So every time that we made a high here, that high was a blow off top high and we came down narrow range. So we are expecting another movement, and it would start with a gap open up, but then it would sell down into these gaps, and that would be the gauge of the S&P. You can clearly see, though, as we said before, there is a huge pullback coming, and it's going to happen at some point in May. It's going to start. And not only that, it's going to carry through June, because if we're going to have a seasonality change, the season changes, summer rally would be coming into effect on the third week of June. So based on what we're seeing here at these resistance levels, there is no follow through, because there isn't. And this is what it looks like. And we're just going to simply show that for the bull does have a case, because here's that low right there. And let me get this all in here. So here, I'm going to contract it just a little bit so you can see it. I'm going to scroll over here. I'm going to let you see that this part of the movement right over here is where they tried to get the big rally going, right here. And we rallied up and we pulled back. So far this year, we do not have a commitment at resistance levels, and what we're expecting, we'll use that daily, then look at that weekly, is a blow off top. You go up, you hit a top, and you start down just like this. This would be the type of move that we're going to have starting in May. We have 1 week of May, and these are the moving averages on a daily, and that's been acting as support. Not only that, when you take a look at the lows here, of course that's higher, And then when we take a look at the lows here, that's higher. And then overall, these lows are higher. But the problem for the bull is there's not any commitment like there was in 2013 to take out these tops, as you can see right here very clearly. And you can see that each rally tries to put in another base, but it doesn't blow through it. So what we're going to say is that if we go up above these highs, it would only be on an intraday level. It could start with the gap open up. That's one scenario. The other scenario is that we just run right up through there, and we could go as high as 1910, and that would equal this kind of trade right here. So you go straight up, but you're going to be having a big sell program that comes in this S&P. And when we take a look here at the distribution, the sell down daily bars, look at them. They're big time. Now, whenever you're going up to resistance level, you're not getting huge buy signals as you did over here with the sell signal. And not only that, you can see the slew of red. And one of the things that we do on our platform is the following. In the MMT application, that application on that daily level is going to have that delta high, and it is possible to blow it off, but we're going to drop. That's what's going to happen. And that the commitment in the portfolio dressing is people were trying to find a home in some of the equities. The bigger players like Icon and Trump and a whole bunch of them are finally smelling roses. The easy money was made. And we're just going to take a look here because we are telling you that at some point over the summertime, from whatever high that's actually going to be, whether it's this one here and or this new one that could happen, is that's where we're going to start looking at the first 7% pullback in the S&P to follow with at least a 10 to 12%. And once again, once these sellers do their thing, there is another tier of fund managers that will still come in and buy these dips. But as they get wore out, they're selling. It's not like calendar 2013. And these red days, you don't have counter bars that are equal or higher value here, but rather that these tops are going to get a little bit lower as they are. And these are just a simple daily moving averages moving forward on that S&P. Now, when we take the S&P, which we will, and we're going to make sure that this monthly movement in the S&P, this is just the beginning month right here. But let's go back to month one. They bought the dip, narrow range. They dipped down here on the S&P, and it popped right back up on that movement. So when we compare that with the Dow and all of these other major indexes, this one here is set up for quite a reversal. The buyer is very shallow on this daily level. So a blow off top, we're going to take a look at 1890 and 1900 S&P index puts that go out to the January, which we're going to start Monday with a major monthly expiration starting tomorrow. Now, as far as premium goes, this is one here that only had a 1.52 range. Now, when we update everybody here on that S&P, we're going to simply say that, look, I'm going to open this up, and one of the things that they've been doing is that they've been buying these put options on the S&P that go out until the month of what? They go out to this month. And here it is right here. I just showed it to you. Those options are going to pay big time. So on an intraday level, we're going to look to see just how this plays out. And I can show you right now for May monthly expiration on the day volume, they were buying put options that were going clear down here to the 1750. area. However, when I scroll up here to get into the January ones now, you're going to take a look at where that big open interest is. This is it. There's 10,1850 puts. That was the volume on Friday. You had 11,000 day volume of the 1870. That one there, for some reason, seems to be an area where they keep going back in case when that S&P goes down. We have the 1875 right here that's been purchased. On the flip side, we got the same amount of calls that people are still trying to buy. That's almost the very same volume here. So as we move forward, there's going to be a lot of volatility. One of the things that I do want to show is the open interest very quickly. When we start with an 1820, there's 65,000 open contracts as far as the put side goes, which is greater value than what the call side is over here. Then at the 1825, there's 61,000. Over here on the call side, 44,000. So we can clearly see that the biggest, oh, and let us not forget, you got 19,000 of the 1835, which is a support level. You got 21,000 open put contracts here at 1840 level. The 22,000 at 1845, if they were snapped or back, they definitely got 27,000. Now here's a good one for you. Let's just go to that 1850. And when I look at the S&P 500 at 1850, we got 112,000 contracts at that particular strike. Now, this isn't May. This is the following month. As a monthly, they are loaded up. On the 1860 at 48,000, they're loaded. Versus the call, you got 40,000 nonetheless, but these put to call ratios are starting to get a little bit more balance in them. 41,000 of the 1865. And once again, I'm just going to show this 1875. That's 51,000 contracts there on the S&P. If we go over here and take a look, we got 51,000 open interest that's been accumulating. And let me tell you that over here on the call side of that 1850, you got 115,000. Okay, so they really believe that 116,000 open interest is going to get paid during the month of June, and that there's 112,000 puts. That's how they're weighted. And it's weighted clearly that there is going to be a major move, because over here on the call side, they start getting really exuberant here, 41,000. You can clearly see that from the 1850 down to, we got 51,000 over here on the 75s, and we got 53,000 here. So we're starting to get more of a balance. It's showing that there's a huge move coming one way or the other, and we just wanted to throw that in here so that you have an idea that this monthly chart is, we have narrow range. And once again, I can only tell you that it's going down without a doubt. And there are many reasons why, and we are way overbought. What do I mean by that? Historically, you could never get to these kinds of levels or these monthly MACDs. There is a supercomputer who has been in control of the buy side and the sell side on this S&P. And once again, the volatility that we're seeing from the daily intraday, there's a huge move coming one way or the other. But let me just tell everybody, any pop up on an open gap up is to go right in there and sell short or buy some of those S&P bear funds on huge volume. And so for Tommy and Johnny and Al, that would be the case in this particular blow off top. It's still going to remain the same. The bull and the bear fight is going to have the implied volatility, and our system says there's a big move coming. But But we are telling everybody that the upside is limited, but the downside is blue skies. And that's the direction we're going to be going. And I'm going to conclude this S&P 500 here. Once again, to all of our traders internationally, happy Mother's Day to your mothers and whatnot, everyone. And enjoy your Sunday afternoon. Just remember, we're going to open up on tomorrow. And we're going to see what this May movement. Now, May historically is not a great month. We shorted this market last year on May 19th. It's right there on StockMarketFunding.com. You can go there. That was a good pullback. But this pullback will be greater than any of the narrow range pullbacks in 2013. And we would start to get these pullbacks when we go back over here to 2011 and 12. We would start to see, like in 2012, these rallies that went up there, but they failed miserably. And they did. I mean, this was early on in the cycle, but I'm just going to give everybody a reference point. We are going to have this movement like this in that S&P at this current 2014 level. And once again, I'm just going to go through this with you, and we are going to have rallies and whatnot, but this particular movement down here is what we're looking at, is that we had 14,000 was a major support level. So I want my new MMTs to understand that when this public indicator called moving average convergence divergence, hey, they pump this stuff to levels that are not sustainable. And when you take a look at the current area compared to some of these other public indicators, we had a daily sell signal, but check it out. This is that daily sell signal that started over here on April 22nd. And right now it peaked on May 5th. How about that? So, shorter time frame, longer time frame, define that overbought, define that short, and get busy, because something big is going to happen in this S&P 500. We have not been wrong yet. It's a matter of the time series. Is you can be right, but you got to have the right time. Or you have to have a longer period of time to take a short on that S&P. So here it is, and this is how it's been moving. Top 1, top 2, top 3. They're being met with what? Well, it's very simple. This is called a distribution. We got up here to 1888, and bam, we sold right off. So these are the kind of movements we're looking for. But then again, you have that dip buyer. Both are equal as far as understanding where that math is that we can clearly show you right over here that dip. But look at that sell. Buy the dip, sell the rip. Oh, and another thing is that every time that we get up higher in the market maker system that we have here, that trade is to be sold short on those intraday highs. And then not only that, I'm just going to be very specific about one thing. What we will have starting tomorrow morning, we're going to be taking a look at some very important data. And the U.S. indices over here that Russell, this 1,000. But all of these movements here that are in the ranges here also look just like the S&P. So therefore, when we get a basket of S&P 500 stocks, which are going to be in here, there will be leadership in this S&P 500. And they've been selling off the highs across the board on the leadership S&P 500. That will be the gauge, is what that range today is You can see how big those numbers are. That means that when we told you before the year even started that this price volatility was going to be huge. And you know what? People aren't even used to that volatility because of 2013. All you had to do was throw a dartboard and everything went up. Well, them days are over.